Welcome to the Advisory Group's Economic Review for the first quarter of 2023. Thank you for listening in on this webinar. Let's first start with some introductions. My name is Manny and I am a Senior Wealth Advisor with the Advisory Group. Also joining me is Brent Beverly, the President of the Advisory Group. Both of us are certified financial planner practitioners. At our firm, we partner with our clients, and we believe that an educated client is our best client. So while we will always try our best to help you, when it comes to your finances, we believe that knowledge is power. The more you know, the more you like what we do. And one of our missions is to share with clients any knowledge that can better help them make an informed decision. Let's first look at the equity markets. Now, the first quarter of 2023 had investors sitting on the edge of their seats as the equity markets took them for a very bumpy ride. Bad news after bad news, it seemed like. The first 3 months of 2023 were a classic example that volatility can be very prevalent in equity markets. Once again, though, we learned not to try to time markets. Despite a banking crisis, war in Ukraine, saber rattling around Taiwan, an initial uptick in inflation rates, additional increases in interest rates, and economic uncertainty, U.S. equities still managed to end the quarter on a high note. The Dow Jones Industrial Average ended up the quarter 0.4% after rising 3.2% in the last week of the quarter, which happened to be its largest one-week gain since the week ending November 11th of 2022. The S&P 500 rose 7% during the first quarter, which was its best three-month performance since the fourth quarter, going all the way back to 2021. Now, the current volatility of markets is clearly something that investors need to be made aware of. In fact, 2022 was a year in which the equity markets saw many movements of 1% or better, either up or down. And 2023 has already started with a high number of highly volatile days. Now, while this level of movement can be a great attraction for media outlets, it can be sometimes unnerving and distracting to long-term investors. Now, to cover some other areas of economic concern, allow me to bring up Brent Beverly. Brent?
Well, thank you, Manny. Despite the first quarter's strong performance, inflation rates remain at levels still well above the Fed's 2% target range. Rates seem to be dropping slowly, though. The U.S. annual inflation rate was 6% for the 12 months ending February 2023, following a rise of 6.4% in the previous period, according to the U.S. Labor Department data published in March 14th of 2023. The Labor Department data published on April 12th reported that, quote, the all items index increased 5.0% for the 12 months ending in March. This was the smallest 12-month increase since the period ending May of 2021, close quote. Now, many economists are hopeful that the future figures will show that inflation continues to slow down even more. As anticipated, the Feds raised interest rates this first quarter. Now, the good news is that the rate at which they increased the range was not so steep as last year's rate hikes when inflation peaked during the summer. On February 1st, we saw a 25 basis point or 0.25% increase, bringing the interest rate range to 4.5 to 4.75%. Then again in March, the rate increased by another 0.25% to a range of 4.75 to 5%. The March increase represented the 9th rate hike since March of 2022. Now, although we saw that the inflation rate is starting to slow and show signs of improvement, the Federal Reserve has stressed that we should not declare victory on inflation too soon. At their last session, they shared that they still expect to bring interest rates up to at least 5.1% by the end of 2023, which means they expect at least one more rate hike before they pause. Now, as a reminder, we just saw that the inflation rate was 5% in March, down from 6% in February, down from even more, 6.4% in January. But this is still way above the Federal Reserve's target of 2%. Now, we don't control the Fed, of course, but many strategists are anticipating at least one more 0.25% rate increase by the Fed. Volatility has been very prevalent in what is typically a less volatile sector for investors. As we noted in our previous webinar, though, bonds in 2022 were especially volatile. Now, bonds are typically a good option for a conservative, diversified, and well-balanced portfolio, as they're usually more stable than stocks. Of course, as your financial professional, we're committed to keeping a vigilant eye on all aspects of financial planning which may affect you, and that includes interest rates and inflation. It may help to revisit the dynamics of how bonds and interest rates work. Bond prices have what we call an inverse relationship with interest rates. That is, when interest rates rise, bond prices fall. The opposite happens when interest rates fall. When interest rates fall, bond prices go up. So remember, this only affects the price of your bond if you sell at that time. If you're able to hold your bond to maturity, you'll get back your par value plus the contracted rate of interest. This is one of the reasons we like to use individual bonds when appropriate. Bonds with a longer time to maturity will fluctuate more wildly than short-term bonds. So let's think about how this affected some of the banks this last quarter. The most dramatic shutdown was that of Silicon Valley Bank, the biggest bank failure since the great financial crisis of 2007, 8, and 9. To make more money in the short run, Silicon Valley Bank bought bonds with longer maturities and what were at the time higher interest rates. And this worked fine until the Fed started raising interest rates to slow inflation. Now remember, interest rates up, bonds down. Silicon Valley could still probably have gotten away with it, except many of their depositors started to pull out large amounts of their deposits, which forced the bank to get funds by selling bonds in their portfolio at very low prices. Now this same dynamic has affected other banks as well. So let's take a look at what it means to investment interest rates, in this case, U.S. Treasuries. Now, Treasuries took a hit when the shutdown of Silicon Valley Bank triggered many investors to run for cover in safer assets, such as government bonds or Treasuries. Now, on the Monday after the Silicon Valley Bank collapse, the 2-year Treasury yield posted its biggest 3-day drop since the aftermath of Black Monday stock crash on October 22nd, all the way back in 1987. Now, the benchmark 10-year Treasury note fell, settling at 3.5%, 3.543% on that time. And as you can see here, by the end of the month, it was down to 3.48. And as we just covered, when interest rates fall, bond prices rise. In this case, if interest rates drop from the January 3rd rate of 3.89% all the way down to the March 31st rate of 3.48%, you can imagine bond prices have risen. Now, Treasuries are still yielding comfortable, favorable returns in this high interest rate environment, but the recent wavering is a good reminder that things can take a turn at any moment. We don't try to time markets, and we don't recommend that you try it. The lesson, once again, is keep a long-term perspective, and when markets go through their volatile fluctuations, just watch them go. As this chart shows, the interest in the interest rates affect Treasuries, and for the first time in over a decade, investors can finally generate what we consider reasonable interest on short-term investments, short-term securities, like Treasury bills and money markets. Putting money in a bank has a cost of safety. So safety comes with a cost, and many major banks are still averaging only low interest rates to savers. According to Barron's, the average bank money market rates on April 4th, 2023 were still only about 0.32%. And the average 12-month CD rate was a whopping 1.61%. While higher than a year ago, these are still very low returns. So remember our look on these rates. After taxes and inflation, these accounts are doing what we call going broke safely. The real rate of return on these is clearly negative. After taxes and inflation, you're going broke safely. So let me bring Manny Chinche back up. Manny?
Thank you, Brent. The economic news remains mixed. Food prices are still increased, and geopolitical uncertainty is still a concern. Now, there are concerns in many locations, especially the Russo-Ukrainian war, as well as between China and Taiwan. However, the U.S. job market remains very strong, so there are, in fact, bright spots. So what does the future bring? As you know, we don't have a crystal ball that works and confidently say that no one can predict the future. We stand by our belief that investing in equities is a long-term commitment. Investors may expect to continue to face a challenging market environment, and the need to look at long-term stability and quality, practicing patience, and proceeding with caution are key to your financial savviness. Now, multiple factors remain key players in the direction of equity markets, particularly the continuation of rising interest rates and speculation of if, how long, and how deep of a recession the U.S. and global economy could see in 2023 and beyond. As your financial professional, we are committed to keeping you apprised of any changes in activity that could directly affect you and your unique situation. We have been through this before, as have many of you. Seasoned investors understand that equities are long-term investments, and long-term investing is not linear, and it requires patience and discipline. So as a recap of the first quarter, here are some things to remember. It's likely we will possibly see at least one more interest rate hike. The cost of borrowing is still elevated, so please don't forget to continue to pay down any debt that you may have and try not to incur any more during the higher interest rate environment. It's always wise to live within your means and minimize any borrowing, but it is recommended now more so than ever. Review all income-producing investments, and as uncertainty remains, remember a well-balanced portfolio should be designed to have resilience in times of volatility. On troublesome days, it can be helpful to avoid too much exposure to the media and to the news. News reports and headlines are largely intended to incite fear and ruffle the feathers of even the calmest of investors. Media magnification could cause anxiety and even cause investors to make emotionally charged decisions, which typically are not the wisest. So this is an ideal time to practice patience and to remain focused on your personal long-term goals. This quarter, Berkshire Hathaway CEO Warren Buffett published his annual letter to shareholders. Now, this letter has been heralded as gospel for decades among investors who are eager to pick the brain of one of the most successful investors of all time, who sits amongst the richest people in the world. Now, his 2023 letter reinforced his views that investing is long-term and that a secret sauce is time. He says there is a, quote, lesson for investors. The weeds wither away in significance as the flowers bloom, end quote. He also quoted his business partner, fellow billionaire Charlie Munger, who said on a recent podcast that, quote, the world is full of foolish gamblers and they will not do as well as the patient investor, end quote. Beyond that, he specifically shared that, quote, we count on the American tailwind, and though it has been becalmed from time to time, its propelling force has always returned. I have been investing for 80 years, more than 1/3 of our country's lifetime. Despite our citizens' penchant, almost enthusiasm for self-criticism and self-doubt, I have yet to see a time when it made sense to make a long-term bet against America. And I doubt very much that any reader of this letter will have a different experience in the future, end quote. So when it comes to investing, discipline and patience can be very rewarding. Let's look at some final takeaways. Now, the current bear market looks like it could continue. Just remember that bear markets are part of the investing experience. Now, how long this bear market will last is yet to be seen. Also keep in mind that the stock markets have risen in the last 2 quarters. So even in bear markets who show volatility, it goes up and down. Now, interest rates are still on the rise. Refocusing and revamping your budget now could provide direction and clarity on where your money is going, what is a necessary expense, and what is discretionary in this new year. Having a solid investing strategy is an integral part of a well-devised holistic financial plan. We help clients create a well-crafted plan customized for their unique situation and goals that take into consideration how each client will react to the ups and downs. We consider many variables, including your time horizon, tax implications, liquidity needs, risk tolerance, and overall personal objectives. Again, caution should still be the principal notion for investors. We feel that the best strategy is to stay the course and focus on long-term investing strategy. And as always, we're here for you. As stewards of your wealth, we are here to help you pursue your goals. So if you'd like to revisit your financial plan or discuss any concerns or ideas, please call our office or bring them up at your next scheduled meeting. We recommend that you not panic into fear in this market. In our opinion, the most important concept of investing continues to be to stay calm and keep a long-term perspective. The advisory group is here to help you stay calm and keep that long-term perspective. Now, to take us to the end of the presentation, allow me to bring up Brent again. Brent?
Thank you again, Manny. Well done. Now, of course, there are some important disclosures that need to be made. So while we're leaving this up, if you could pause, make sure you understand the disclosures and what's going on with this. We would appreciate that. We're thankful for the opportunity to assist our clients in doing this, and we appreciate we can help you with your financial needs. Remember, at our firm, clients come first, and your health and well-being is always our highest priority. That concludes our discussion. If you have any questions, please reach out to us. Here's our contact information. And thank you again for viewing this presentation. For everyone, we hope you have a wonderful, safe, and healthy 2023.